All right, let's talk MoneyHero. They just dropped their Q2 earnings, and honestly, it's a perfect example of a classic Wall Street headache. You've got two completely different stories fighting for the spotlight. On one side, you have this fantastic, well-executed pivot to profitability. But on the other, you've got a top-line revenue number that the market just could not stomach. So let's get into it and break down what on earth happened.
And here it is, the whole puzzle in a nutshell. MoneyHero delivered a GAAP EPS of 0, flat. That's a solid beat compared to the 2-cent loss Wall Street was expecting. So check, that's a win. But at the very same time, revenue landed at $18 million, which was a good $2 million shy of what everyone was looking for. This right here, this is the beat versus the miss that really defined the whole narrative. So what was the market's immediate reaction? Well, a brutal 18% drop in one day. It seems like the streets saw that revenue miss and just hit the sell button, sell first, ask questions later. Our job today? Let's answer those questions.
Okay, so let's pop the hood and look past that big headline number. We need to see what's really going on with the core financials of the business.
Now, this is where things get really interesting. I mean, look at the contrast here. Yeah, revenue was down 13% compared to last year. We know that. But look at the bottom line. The company swung from a $12 million loss to actually making a small profit. And their adjusted EBITDA loss, that improved by a massive 79%. Look, that doesn't happen by accident. That is a sign of a huge structural shift in how this company is run.
And this chart, this shows you exactly how they pulled it off. Operating expenses were just hammered, down 37% from last year. We're not talking about just trimming a little fat around the edges here. This was a complete reset of their cost structure. And that's what allowed those profitability numbers to look so good, even with less revenue coming in the door.
And that cost discipline wasn't just some random panic move. No, it was a deliberate part of their strategy. So let's take a look at the playbook management is running here. And here you have it, straight from the CEO, Rohit Murphy. Reshape MoneyHero for durable, profitable growth. Prioritize quality over quantity. Honestly, this one quote tells you everything you need to know about this quarter. They knew they were giving up some lower quality revenue because they're trying to build something more sustainable, more profitable for the long run. So what does quality over quantity actually look like on paper? Well, it looks like this. They intentionally pumped the brakes on volume in their lower margin credit card business. And at the same time, they were pushing really hard to grow their higher margin stuff like insurance and wealth. And look, it's working. That segment now makes up 27% of their total revenue. That's a full 5-point jump from last year. Now, the engine behind this entire pivot is technology. Management's leaning really heavily on what they're calling their AI intelligence playbooks. You've got rewards intelligence, which helps them fine-tune user incentives and lower their costs. Then there's approval intelligence, which is all about sending better, higher quality applications to their partners. And finally, yield intelligence, which just works to squeeze the most value out of every single user. You put all that together and you see this isn't just about cutting expenses, it's about building a smarter, more efficient machine for growth that actually makes money. Okay, so the strategy seems pretty solid, right? The bottom line is getting way better. They seem to be executing on their plan. Which brings us all the way back to that one big nagging question. Why did the market just absolutely trash the stock? If management is doing exactly what they said they were going to do, building this durable, profitable company, why did they get punished so severely for it? And here's where the two stories collide. If you listen to the earnings call, management was talking all about the sequential story, how revenue grew over 20% from Q1 of this year to Q2. They see the momentum building. But the market lives and dies by year-over-year comps and those consensus estimates. All it saw was the annual story, a 13% revenue drop and a miss. You've got two completely different narratives. And on earnings day, the market's narrative always wins. So, knowing all of this, how should we be thinking about the next quarter, and really, the rest of the year? Let's get to our official call. Looking forward, management's given us a pretty clear roadmap of what to watch for. First, they're targeting adjusted EBITDA break-even for the second half of this year. That's a huge one. Second, they expect that high-margin insurance and wealth business to climb to about 30% of total revenue. And finally, keep an eye out for the launch of something called the Credit Hero Club, with TransUnion in Q4. Hitting these targets is absolutely crucial for them to prove that this whole strategy is the real deal.
So here's our prediction for next quarter. We think this transition phase is going to continue. And what that probably means is another year-over-year revenue decline. And yeah, maybe even another miss against consensus if those analyst estimates don't come down. But on the flip side, we also fully expect to see their margins get even better and for them to take another big step towards that break-even target.
So, based on all that, our rating is market perform. Look, the execution on cutting costs and the clear-headed strategy are really impressive. You have to give them credit for that. But the uncertainty around revenue is a major overhang, and the market is just not going to ignore it. Until they can show some stability on that top line, the stock is probably just going to trade in line with the broader market.
And finally, let's wrap this all up into a potential trade idea. It's really built on the central theme we've been talking about this whole time: discipline versus growth.
Here it is, a classic pairs trade. You go long MoneyHero, making a bet on their proven cost discipline and their expanding margins. At the very same time, you go short a basket of their consumer fintech peers. You know the ones, the companies still chasing growth at any cost, burning through cash, the ones who haven't made this tough pivot to profitability yet. This trade is basically a bet that in this kind of economic environment, the market is eventually going to reward MoneyHero's discipline over the undisciplined, unprofitable growth of its rivals.
And that's the Q2 story for MoneyHero, a bet on discipline in a pretty uncertain world. As always, this is for informational purposes only. This is not financial advice.